Happy Monday, everybody. And I'm going to do another story today. And this one revolves around banking because there are some similarities to what we're seeing today versus what we saw way back in the Lehman era. So I'm going to take you back to early 2008. We saw three companies go down, bam, bam, bam. Bear Stearns went down, Century went down, and AIG went down. And people were starting to freak out. Well, what's going on with housing? What's going on in banking? What's going on with mortgages? And that's when Ben Bernanke, he was the chairman of the Federal Reserve back then. He came out with his famous containment speech. Don't worry, we have it contained. We understand everything that's happened here, and there is no chance that we're going to have a contagion. It's all okay. The famous containment speech. Well, it wasn't okay. And they knew it wasn't okay. And we all know what happened. In September, down goes Lehman, and all of a sudden the world's going to end unless we do $700 billion by Monday morning. It had gone down on a Thursday anyway. And then the whole thing just cascaded into trillions of quantitative easing, printing money to bail this thing out. So why bring this up today? Well, we're starting to see some things in banking that are giving us some pause. But before I get to that, right after those events, well, not right after, in 2012, Congress finally got around to hearings on this thing. And Jamie Dimon, he was the head of J.P. Morgan at the time, and actually still is. Here's what he said to Congress. We have to get rid of anything that looks like too big to fail. We must allow our biggest institutions to fail. I wouldn't call this resolution. I think that's the wrong name. I think we should call it bankruptcy. Personally, I call for bankruptcy for, here's the catchphrase, big, dumb banks. I think when you have bankruptcy, I'd have clawbacks, meaning taking money from bonuses, this kind of thing. I'd fire the management. I'd fire the board. I'd wipe out all the equity and the unsecured debt. And debt holders should only recover what they recover like a normal bankruptcy. Wow, way to go, Jamie Dimon, being accountable. The big dumb banks speech. All right, let's spring forward to 2019. We started to see trouble in the banks just before COVID. And if you kind of look at this chart, the second little bar chart there is J.P. Morgan. And what are they doing? They are taking money from the Federal Reserve because they're in trouble. No talk of bankruptcy there, no talk of them going under, no accountability. By the way, you also saw some Japanese and German banks on that list, but I've discussed that previously. So why bring that up now? Well, COVID hit, money flowed like crazy, and suddenly the banks were all okay. Spring forward to just recently. What I'm about to show you is, let me just read it, the secured overnight financing rate. Now, what is this? When banks get in trouble and they need cash, you can do, it's like a payday loan up to the Fed. Give me money, I need it now. Look at this chart. See that great big spike there that's circled? That's the highest of all time. That just recently happened. This is starting to look a little bit like what we saw in 2007, 2008, in the months prior to Lehman Brothers. Now, we have not had any containment speeches yet. There's been nothing like this, but the rumors in the banking world are not good. And it's not just here. You've heard us talk about what's going on with Japanese banks, what's happening with European banks now that war is on their doorstep, and what's happening here with our derivatives. We've talked about that, the bets that the big banks have made in the hundreds of trillions of dollars. So what we're saying is you don't have to go and close all your bank accounts, but be aware that we are possibly seeing some similarities to what we've seen before in the banking industry. You do not want to exceed those FDIC limits. And I will leave it at that and turn it over to Walt.